Hello, welcome back for another portfolio update video. Since the last portfolio update video, I have made 4 transactions. So I have bought Google, Netflix, and Snowflake, and I have sold 3 shares of Tesla. Let's start from Tesla. The reason I've sold Tesla is because first, I think that it is overvalued now at current price, and I think that there's a lot of FOMO feel in the stock right now. And the second reason is that I'm using the proceeds to buy into other companies that I would like to own. The intention is get to the target allocation sooner rather than wait for me putting money into the account. Next, let's talk about the companies that I have purchased. The first company is Snowflake. So Snowflake is basically a data warehousing company. It offers cloud-based data storage and analytics service. At the first, when this company was created, it was only built on Amazon AWS. And subsequently, they also broadened up and it now is able to run on Microsoft Azure and also Google Cloud Platform. And the data exchange that offered by Snowflake actually allow the companies to share data with each others. In terms of the value proposition, based on the feedback from the customer, it is easy to use and it offers massive scalability of data volumes. It offers diverse data type, and in terms of pricing, it is optimized for the price performance, meaning that the customer that use Snowflake actually pay per use. They don't have to maintain their own infrastructure. I think all this value proposition is very good for the customers, and they can do things that now cannot be done using the on-premise servers. And that is why we can see that in terms of the sales growth, it is growing very nicely every quarters. And year-on-year growth so far is about 121%. And given that they are able to grow so fast, I foresee that their size will getting very large in just a couple of years. Let's also talk about the risk of these companies. There are 2 main risks that I can see. Number 1 is the valuation. So currently Snowflake is trading at about price over sales of 45. This is price over sales, not price over earning. So you can see that market is willing to pay a lot for a very high growth company. And second reason is that the services that offered by Snowflake is not unique. In fact, they have to compete with the big tech out there, which is Amazon and also Google. And their relationship with Amazon and Google is also quite interesting because they are using their infrastructure, meaning they're using AWS and Google Cloud Platforms. At the same time, they are competing with one of their products. For Amazon, it is known as Redshift, and for Google, it's known as BigQuery. So far, based on the material that I read on the internet, the performance offered by Snowflake is better than Amazon Redshift and BigQuery, but depending on how you look at it, for example, Amazon Redshift, it is very well integrated with the AWS. So for certain clients, it might be more natural for them to get Amazon Redshift rather than Snowflake. So for Snowflake, given that the share price is very high, my plan is just to get some exposure into the company. And if I see that the share price drop and trading at a more reasonable level, then I will buy more. So this is just a quick introduction on Snowflake. Let's move on to the next company. So the next company is Google. I only bought 1 share. If you recall in my previous video when I talked about Facebook, I said that Facebook together with Google is having a monopoly status in the internet advertising space. So in the chart that I'm showing here, Google market share is about 31% as of 2019. So in terms of the services offered by Google, I can say that literally every day I'm using Google services. For example, like Google Maps, Google Search, Chrome, and so on. But if you look at their income statement, actually most of their revenues is derived from the Google Search. For the other segment, for example, like YouTube, Google Cloud, and so on, they actually didn't contribute a lot of revenues to Google's compared to their core products, which is the Google Search. And for the core product, Google Search, it is projected to grow in the coming years, but it's not going to grow at a very high growth rate. So Google is still working hard to expand their revenue from other segments, particularly on the Google Cloud. I read that they're going to increase their sales force in the Google Cloud to help them boost their sales. So in the cloud segment, their 2 main competitors is of course Amazon AWS and also Microsoft Azure. Google Cloud is at the 3rd place and they're working hard to grab more market shares in this area. So I'm sharing this article from TechCrunch. Google is aggressively expanding their data center presence around the world. So if we look at the fundamentals of Google in terms of their revenue and net income, definitely this is a very solid company, and the share price is trading at a valuation that is very reasonable. However, there is also a reason why the company is not trading at a very high multiple. One of the main risks is definitely the antitrust, similar to Facebook. So the antitrust issue, I think, is not going to be resolved in short period of time. So we probably will see that this will drag on for quite some time. That's it about Google. Let's move on. The last company that I would like to talk about today is Netflix. So Netflix is currently the top streaming company in the world. Their number of subscribers worldwide is close to 200 million. As a side note, I will share 4 of my favorite TV series from Netflix. So the first one is Stranger Things, second one is Money Heist, third one is The Witcher, and the fourth one, this is a TV series from Germany. It is called Dark. If you haven't watched this, I strongly recommend that you watch it. It's talking about time travel. So I won't get into the details in terms of the fundamentals, because if we just study the fundamentals, actually Netflix doesn't look like a very good company. The reason is that they're spending a lot of money into TV shows production, and the more money that they spend means less money for the shareholders. Then you might ask, why am I buying this company even I say that their fundamental is not good, right? So in terms of their business model, it is actually quite simple. Their strategy is also quite straightforward, which is to get as many subscribers as possible. And once they are able to hit a very high number of subscribers, for every show that they made, they can spread out the cost to many subscribers, means that it is cheaper for each of the subscriber. And imagine that for a new competitors that want to compete with Netflix, before they hit a very high subscriber base, they have no choice but to subsidize it and to make some losses while expanding their number of subscribers. The TV streaming business is a lucrative business if we look over long term, hence there's of course competitions. And the latest one is Disney, which just recently hit 86 million subscribers. I personally is not very concerned with Disney compete with Netflix, because unlike for example like telco, where we only need one telco, if you already have Singtel, there's no point to get StarHub, right? But for streaming, I believe that customers that subscribe to Disney will also keep their Netflix. They are just going to subscribe to multiple streaming services. And the CEO, Reed Hastings, also said previously, their competitors is sleep rather than the other companies. So I think the point that he's trying to make is that as long as they are going to produce good contents, and as long as their customers enjoy their shows, they will have no problem to grow their business. So that's it about this episode. Thank you for watching. See you in the next one.